The opinion you should follow should be your own. Just consider this video to be a second opinion from a complete stranger online. Consult a financial professional before you invest. Remember to educate yourself first and have the ability to ask the right questions. Hold your financial professional accountable. You and only you are accountable to your wealth and legacy. Welcome to the Wealthy Bucket. In today's session, we're going to discuss Forex, or currency trading. During this session, we will cover these three topics. What is currency trading? How is currency traded? And how to interpret the data. So what is currency trading? Currency trading is simply another vehicle or an asset class that an investor can use in their portfolio. There are a number of reasons an investor will use currency trading within their portfolio. Investors can use currencies as a form of income generation, or investors can use currencies to hedge risk within their portfolios. As investors become more and more savvy, they are investing in multiple markets across the planet and can leave themselves exposed to foreign exchange risks. By using a well thought out currency strategy, an investor can attempt to zero out any currency or foreign exchange related risks within their portfolio. Don't worry if this sounds a bit complicated. If you're not consistently profitable within your decisions, then hedging is the least of your concerns. When it comes to currency trading, an investor is simply betting that a particular currency will be stronger or weaker against another currency. Just like investing in stocks, options, futures, or bonds, the investor will be financially rewarded if the decision was correct. We will take a closer look at how this reward is calculated later in this session. So how is currency traded? Currency, or foreign exchange, is traded just like stock. There is a bid and an ask price. The market is liquid and in some instances can be traded 24 hours a day, 7 days a week. The Forex market is not an auction market like stock. The Forex market is over the counter, or OTC. It resides in what we call a dealer market. This can be advantageous for investors who understand the market, who are consistently profitable, who are strong decision makers, and are great at managing their money. For investors who are just starting out on their investing careers, we recommend that Forex trading should not be your first choice. The cost of starting a Forex account is very low and thus attractive. The problem is that the Forex market is fast and your startup capital can be absorbed by other market participants very quickly. Always learn first. It's your money. You worked hard for it, so learn to keep it. Investors who are sprinting to make money usually get a dose of reality right quick. Let's get back to how currencies are traded. As you can see, the image on the left is that of the Euro-US dollar pairing. This is by far the most commonly traded pairing worldwide. You will notice that the chart looks very similar to a stock chart. In fact, they are identical. We believe if you can understand how to interpret a chart, it shouldn't matter what asset class an investor trades in. A chart is a chart is a chart. Understanding what makes the instrument move is a discussion for later sessions. The image in the right is the best available bid or ask displayed to an investor. Again, trading Forex is very similar to stock. The investor who chooses to trade Forex is required to construct a trading plan to illustrate entry and exit. We covered this topic in a previous session. Now, how to interpret the data. For the next 2 slides, we will illustrate how an investor can interpret this data. we will be using the Euro-US dollar currency pairing for our example. When an investor buys this pairing, they are expecting the euro to appreciate against the US dollar. For example, the investor can purchase 1 euro, which during the time of this recording had a value of 1.3398 US dollars. Since the investor is bullish on the euro against the US dollar, it is in the investor's belief that when the time comes to sell the investment, the value of the euro has increased against the US dollar. In this example, as long as the investor sells the investment for more than 1.3398 US dollars, which was the purchase price, a profit will be recognized. Currency pairings are always reflected in a primary and secondary currency. For this example, the primary currency is the euro. The secondary currency is the US dollar. All profit and loss will be reflected in the pair's secondary currency. For this example, all profit and loss will be reflected in US dollars. Let's take a closer look at what profit or loss would look like. This example is assuming that an investor has leverage provided at 100 to 1. This simply means that the investor only requires $1 to control $100. Forex trading is always expressed in contract sizes. In this example, we will be using one standard contract, which is the equivalent of $100,000. Should the investor buy 1 Euro-US dollar contract based on the current price during this recording, then the contract or investment would have a value of $133,980 US dollars. Since the investor is using leverage of 100 to 1, then the investor would only be required to invest 1,000 euros to control one contract. For every point or pip that the investor is correct, then a 10 US dollar profit is received. For every point or pip the investor is wrong, then a $10 US loss is received. Pips or points is simply terminology that market participants use in reference to the change in price that is expressed starting from 1. For example, if an investor buys Euro-US dollar at 1.3398 and then sells the investment at 1.3400, then the investor would experience a 2-pip increase with their investment. We will cover more on Forex or currency trading in future Wealthy Bucket sessions. We sincerely appreciate you investing your time with Wealthy Bucket. Please follow us on Twitter, Facebook, and YouTube.